Welcome everybody. My name is Dickon Thornley. I am an audit partner here at HW Fisher. My background is having spent 15 years at Grant Thornton and a couple of years at Sedula leading their audit team. I've joined HW Fisher here in London. We're, for those that don't know, based near the Euston office, the Euston station. We're under one office team of 300 across all the varying departments. We're part of the wider summer networks and summer group, so I have a national offering as well. The aim today is to talk about the upcoming changes in FRS 102 that are coming around the corner, and the key focus today is revenue and leases. We're going to go through them in quite high level. As mentioned, we are going to do some other webinars with a bit more deep dive, so specifically looking at revenue, working through some worked examples and looking at leases, and again using worked examples, whereas this is a bit more high level, picking out some of the key changes, thinking about some of the implications and what you need to be thinking about, and what some of the impacts might be. There are a number of other changes within this periodic review that will also be coming into place. We're not looking at those in such big detail, but we will also touch on some of them. But clearly the revenue and the leases are the key impact. So that's the key of what we're looking through. So kicking us off, when are these all coming in? So these are now coming in for periods commencing 1st of January 2026. So we are around 6 months from that. So that will be the start. So it will really be impacting that 31st of December 2026 year end. You can early adopt, you have to early adopt everything. You cannot pick and choose to early adopt some things and not others. So just be aware of that. It can be done, but you do have to then go through and make sure you're adopting everything. So we're going to kick off with looking at the revenue, the changes in section 2023. So there are some quite significant changes in this. Effectively, the FRS 102 is now moving towards IFRS 15 revenue from contracts and customers. This is looking at a sort of 5-step revenue model. Now, I think the difference here, or one of the key differences, is it is much more prescriptive now, of what with very kind of considered and more precise requirements in comparison to the previous section 23. I think it's something like 140 subsections in the new guidance, whereas the current guidance is about 40. So clearly a lot more detail and a lot more prescription in there. It will have some quite big impacts. It won't have sort of a huge impact on certain organizations, but there is a lot to think about. One of the key sort of pieces is even the aspect of talking about control over the goods and services in contrast to risks and rewards. So there are sort of fundamental changes throughout it, but looking at it as a whole, it is going to be this new 5-step model that we'll go through now. So looking at that bit one by one, how do you factor it all in? So step 1 in that new 5-step model is identifying the contracts. Now there are sort of prescriptive criteria that they set out now, and it's got to be approved by both parties. You cannot have a one-sided contract. Some of these seem obvious and can be sort of implied. So a receipt from a sales and from shopping, that those kind of things can be considered a contract. It is not that we are all moving to sign contracts with our customers, depending on what we do, but we have to sit there and we have to identify at the first point, was there a contract? Is there something implied? So have the payment terms been applied? Is there commercial substance to it? And so, as I say, this could be as simple as a till receipt through to a more complex long-term, say, construction contract. So identifying the contract is probably one of the easier parts of the steps, but that's absolutely the key starting point. I think where it starts becoming more complicated is thinking about performance obligations, and here again, taking a lot from the standard, while we're sort of splitting this through, and we will sort of send around these slides as well. It is sort of clear there. Performance obligation is a promise in a contract, and these are sort of different terms from the current standard, and with the customer to transfer either a distinct goods or service, or a series of distinct goods or services that are substantially the same. Now, this distinct goods or services is really important when thinking about performance obligations, because especially, is it a point that we can then apply the revenue, and we should be thinking about recognizing the revenue, or actually is it a contract over the length, and can you separate it out? So what they mean by distinct is that the customer can benefit from it either on its own or together with other resources, and it is separate from other promises in the contract. So it has to be a standalone, distinct piece to have a performance obligation. The standard then gives us ideas of when it isn't distinct, when it wouldn't be a standalone. There isn't a single performance obligation. So this is areas where the entity provides a significant service of integrating goods. So this is representing the combined output. So when you're not being able to separate them out, these are sort of areas of construction contracts where you may be promising varying things, but actually it's combined into one sort of output. So one or more services significantly modifies or customizes other goods. Again, the idea where you cannot separate these parts out, so you cannot apply a distinct promise there. So when you can't, there is no performance obligation at that stage, and it would be created at the back end when it's all delivered. So looking at performance obligations is talking about, can you separate it into distinct areas or patterns, or is actually it all combined into one, and until we've delivered that performance, we can't separate them. Additional considerations within there: warranties, changes in things like this. So is it a warranty that would be treated under Section 21 provisions and contingencies, or is it an additional service? So is it something that you could sell warranty separately, or is it a compulsory warranty that you have to have? If it is an additional warranty, something that you can sell separately, something you don't need to have, often you get these buying white goods or otherwise, where you can purchase an additional 2 years warranty. That's an additional service. So that is something that is a separate performance obligation. You're buying it separately. It isn't part of the terms. Whereas something that is a compulsory warranty, now that falls under the provisions and contingencies of when you're expecting is that something that you're going to have to account for. Non-refundable upfront fees. This is quite sort of a change, I guess, because the current standard doesn't really talk a huge amount to this, but so it's often in sort of implied, if it's non-refundable, people have been recognizing it immediately because they're not paying it back. Under the new standard, this is reviewed and considered, because non-refundable upfront fees might be a hotel booking. You book the new standard looks at that and considers it going, even though it's non-refundable, have you delivered on the service that the customer has paid? So actually, this should be not taken up front. So again, thinking hotels an obvious one, gym memberships, other pieces like that where you get that non-refundable. Um, Actually, no longer are you taking that and recognizing that up front. That should be taken into consideration with what actually is the item that the customer is paying for. So if it is a hotel, is it the night that they're staying? So you may get a non-refundable to, payment up front, but actually if they're not staying for 2 months, you shouldn't be recognizing that revenue now. So that's quite a sort of a big change again, because they're being a bit more prescriptive. They are talking around principals and agents. There's just some nuances in the words now, and consideration there. So again, something that has to be considered. Customer options for additional goods. So this is where potentially you could be offering a buy one now and get 40% discount on your next purchase. So these are now areas that you are selling something that could be a distinct, and then therefore that should be accounted for differently. So how does that work if you're saying that you can buy one now and then you've got a 40% discount going forwards for a couple of months, and taking that into consideration and into that purchase and recognition of revenue. As I say, we will deep dive into some of these in the standalone revenue pieces with some worked examples to bring it to life a bit more. Today we are just trying to go over a little bit sort of higher level to start thinking about where incidences could impact your organizations and how you report for it. But yeah, that's that customer options for additional goods or services, thinking about future different discounts and how that impacts your recognition. So quite a few nuances and things to think about within the performance obligations. Within that, then we move to step 3, which is the determining the transaction price, which is the amount of consideration to which an entity expects to be entitled in exchange for transferring goods or services. Obviously, fundamentally, there are very basic sort of terms. It'll be quite straightforward what a purchase price is, say in a shop, but there are a lot of other aspects to then think in variable consideration, rights to return and refund, and how you expected to take that sort of liability or refund. There is now a refund asset held as inventory, which is quite a big difference. Thinking about time value of money and recognizing that. So is it a purchase now that's not being paid for, or being the payment is being spread over a period of time? So at that point, you think about discounting that down to what the current value of that money is. So there's a lot of additional pieces, non-cash consideration. So this could bring into play sort of fair values, how you're measuring that. The new standard talks a lot more about fair value, and there's some changes there from the current standard. So there can be quite a lot of changes. Variable consideration, we've got discounts, we've got those rebates, we've got refunds, we've got performance. They're all sort of parts in there, and then it's going to be, how do you factor that into your transaction price? So it's based on expected values. So this could utilize sort of historic data. How do we work that to give us our best estimate? It could also be based on the most likely outcome of varying scenarios. So what is the most likely situation that's going to come out? Where do we sit at that point? But what we do have to do is, we can't chop and change between historic to most likely outcome in that same sort of contract. So we can review if we've got different revenue streams and use sort of a variety, but you can't start sort of sales and then sort of halfway through, if it was a longer term contract, suddenly change your estimation basis. And therefore, and this is the key, obviously, we're only including amounts of variable consideration that it the extent that it is highly probable. So again, there's no percentage terms of what highly probable is, but looking at that expectation, when we're selling things and there are refunds, what does potentially the historic data show us? How likely is someone to return? Discounts and rebates, how likely are we going to meet certain targets? What can we see? How can we estimate? We've got to start using a bit more judgment in those bits where variable consideration is an option. Obviously, at the end of each reporting period, we need to reconsider that estimate, so there can be changes within it to reflect it. Maybe something that was very likely has moved, or vice versa, something that we didn't think has become more likely. So we've got to revisit those estimates at each reporting date. So again, a lot more judgment and estimating in that transaction price. For a lot of us, for a majority, there will be very basic. It's the price on sale, but there are all sorts of varying factors that now have to be considered, taken into account how we're accounting for it. Step 4, once we've understood and thought about our transaction price, we've got to allocate it. So we've got to allocate it out to the areas within in those performance obligations. So what does that transaction price look like? How does that go to the varying performance obligations? So things to think about here is where you might sell individual items at a certain price bundled together as a sort of almost sale. There's a discount involved, so therefore it's a cheaper option. But how are you allocating those sort of two items? So if you had, I don't know, a lawnmower was for sale, and then obviously if you got the lawnmower and the trimmer at the same time, just I've clearly spent the weekend gardening. If individually they would cost a certain amount, if you bought them together, there's a discounted value. You've got to then consider, that's the transaction price, but how are you allocating those that discount? How are you allocating that to the performance obligations for what you're selling, the goods and services that are promised in their contract? So sort of unbundling certain things is again, it's about not just the transaction price, but how that is then allocated into the performance obligations that we're selling. So hopefully they're, in the majority of cases, it's relatively straightforward. They're observable prices. My example, you would normally have those sold with particular prices. There are obviously situations where it's not directly observable, and then you've got to estimate it and allocate it. The new standard, again, a bit more prescriptive on how you go about estimating it. Is it around sort of the adjusted market assessment? Is there a sort of a cost to you plus a sensible margin? So that's another way of looking at it, or a sort of as a residual value approach. So again, it is a little bit more detailed, hence the significant increase in subparagraphs in section 23 on how you can go about estimating to hopefully give a little bit more guidance. Step 5 is recognizing the revenue. You've gone through all of those different sort of pieces to I suppose getting to this point, and thinking about, when do you do it? Is it at a point of time is it over time? So when we're talking about at a point of time, you're thinking about the customer obtains control of the asset. Um, and then there are these indicators. What does it look like for control of the asset? And going back to what I said at the beginning, one of the fundamental changes as well is thinking about not transferring risks and rewards. That is just one part of taking control now. So in the new standard, we talk about control of the asset, not when the risks and rewards are transferred. That is just one of the indicators that control has been transferred. So that's quite an important concept and a pretty fundamental change in the new standard. So indicators there, recognizing revenue at a point in time. Obviously, if those criteria aren't met or one of the following, it is then recognized over a period of time. So when if the customer is simultaneously receiving and consumes the benefit, you should be recognizing it at that point. So they're the two key criterias, either at a point in time or over time, and thinking about that over time, where we're spreading that revenue. So thinking about how if you're creating an asset, one of the key ones there is it's got no alternative use. So if the customer pulled out of or tried to pull out of the contract, you've got, and you're building something or making something, and you couldn't sell it to somebody else, you couldn't use it for something else, you couldn't take it from that project and put it onto that project. These are areas where you should be recognizing your revenue and thinking about that. So it's not based on one customer. Is if you could take that project or take that asset and put it into another project, then potentially you shouldn't be recognizing it over time, because you could sell it to somebody else. But that overtime piece, there are going to be two different types of methods and how you recognize it, and you'll need to sort of choose. And there's a judgment between the output method, that's end product, and the input method of what's going into the project. So there's a bit of choice there. There's a bit of further consideration on how to recognize it over time. But so again, that's something that you'll then need to apply consistently, rather than sort of jumping around. But it's identifying, can you recognize it over time, or should you be recognizing it at a point of time? And if over time, are we looking at output method or input method? One of the other changes in FRS 102 is the ability to capitalize some of the costs. So we can capitalize now costs to obtain a contract. So areas that cost those that would not have incurred if the contract had not been attained, so sales commissions, those kind of things. So these can be now capitalized and spread across that period of the asset, as it were. So that's not something that previously we could do or currently can do until the 1st of January. So there is an aspect of now being able to put some of those costs of obtaining new contracts onto the balance sheets, amortizing it over the period, and obviously considering it for impairment as well if the contract was lost or other methods, and also looking at cost to fulfill a contract. These previously weren't there in the current standard, so these will be coming in. It's a similar sort of recognition criteria, and some of them actually, although sort of directly to the contract, there are other costs that could be considered as well, that can be allocated to that contract, and can be capitalized and then amortized over the period of the contract. So these are quite big new changes as well, so that they can help, I suppose, matching some of these costs that have only been incurred because of a longer contract. Obviously, it's a point in time. You're not going to spread these, but you can take some of those sort of pieces and now capitalize them on your balance sheet. So just a couple of the definitions here, which sort of similar in their read to sort of current, but we're talking about contract assets and contract liabilities. So thinking about what we have to deliver again across as a liability. Clearly, this is going to have quite a big impact on disclosures, how we go about it. So there's, it is a very prescriptive, again, I keep using that term, but that is because there is a lot of detail, so it should be sort of read out. But there will be changes, and quite significant changes in the way that we need to disclose things in our financial accounts, right from changing up and thinking about our accounting policies, through to a number of these areas that could now be impacted, how we look at the different types of goods and services that we provide, the different types of revenue streams that you might have, all the way through to thinking about what the performance obligations, how we're splitting those things down, and which ones are recognized point of time versus over time, all of these pieces. So there will be quite a lot of changes, even if fundamentally the 5-step model doesn't necessarily change the way you are currently accounting for your revenue and your revenue recognition. The disclosures are more detailed. You'll have to think about your accounting policy, changing that to make sure it is aligned to the new standard. Practically, there are some other things that might need to be thought about. We've talked about if there are some delays in some of the revenue recognition from currently how we're recognizing it, or there's a spread or separation, some of the bundles that we're selling. This could have impacts on KPIs, performance related payment schemes, budgeting, tax as well. So there are quite a lot of internal practical challenges that the change might have. So not only is it working out, right, have I got any changes in revenue? How am I aligning to this new 5-step model? But it's not then going, perfect, I've resolved it for financial reporting, for auditors to come in and be happy with my accounts. What does that fundamentally mean to the business? Does that change the KPIs I'm reporting to management, to stakeholders, to shareholders? Does that change the ability, does it change sort of covenants? Does it change people's payments, performance bonuses and things like that? How are those structured? Are we thinking about those? Because there's a knock-on effect if we change the way our revenue is recognized. So that is why it's really important to start thinking about before the financial year, because you don't want to get halfway through the financial year next year in 2026 and realize KPIs aren't going to be where you thought they were going to be at the end of the year. A lot of disappointed staff or senior figures if bonuses and performance doesn't suddenly look as good because we're making changes later in the year and that's not been taken into account in our forecasts and how we look. What does it impact on covenants and forecasts if we've got bank loans and other stakeholders in that respect, even dividends and dividend payments, because it could have an initial knock on distributable reserves. So there's quite a few internal practical challenges that we need to think about once we've got to the stage of, is there an impact? How is it going to impact? And are there changes that need to be made fundamentally in the way we recognize our revenue? So again, this sort of stressing the idea of looking at it over the next 6 months, not waiting till 2026 necessarily to really sort of dive in, but also think about high level. You might have gone, yeah, there's no real changes, but there are quite a few nuances. We've gone through some of those. So really thinking practically, could this have an impact on the business? Should I be updating sort of shareholders, stakeholders, board members that possibly aren't as aware of the impending changes? So that's a whistle stop tour through revenue, through the changes, some of those, that 5-step model, and what does it really sort of mean and get into. Ultimately, as I say, we'll run an entire webinar and spend the hour and doing much more sort of practical examples and talking through real life examples. And obviously, if anybody's got scenarios they want to message in, we can bring them to life in the next one. We can obviously come back separately, but we can start using sort of live examples to help people think about what are the changes. So we'll get into those in the detail, but high level, it's coming around. It is quite complicated. There are things that need to be thought about and sensibly worked through, and a lot of stakeholders that might need to be talked to. So the other fundamental change is leases, and this is again a real impact. The aim here is bringing it more aligned to IFRS 16, so on balance sheet lease accounting for lessees. We're really going to look at the lessee implications during this. There are obviously sort of guidance for lessors, but this today we're going to look more at the lessee situation and think about there. I mean, comparing this to the current standard, this is, fundamentally, there isn't really much comparative. This is taking those operating leases is the best way to kind of describe it, and using them similarly to a finance lease. So bringing those lease obligations onto the balance sheet and effectively bringing the asset on to the balance sheet as well. So we're looking at these sort of leases, so obtain substantially all of the economic benefits from use, direct use of the asset. So I think the old sort of the finance lease is you'd get the benefit and substantial economic benefit of the entire asset for the duration of its life. Now we're thinking, is it a lease? Is there an asset? These are substantially the economic benefits from use and direct use. So that means that even using a photocopier, as it were, is that you are getting a benefit from. So that is why operating leases now are being treated the same. So there are exceptions to what we need to bring onto the balance sheet. So these are short-term leases and low value assets. So short-term leases, logically this is 12 months or less. I think the caveat there contains no purchase options. So the guidance here is, well, obviously, if you've got an asset that is 12 months or less, or you're in a lease, you don't have to bring that onto the balance sheet because it's not worth the time. You will expense it and recognize it as currently being recognized. So that will just be your usual operating lease that will just go through as an expense. Low value assets. Now, this is slightly more. We've got some examples on the next slide. This is key. It's based around the value of the asset, regardless of whether or not it's material to the organization, to the business. So, what it's trying to move away from is going, well, you turn over £100 million is an asset of £25,000 immaterial to the business. Well, it might be, but what they're trying to describe here is you don't have to include if it is low value. Doesn't matter what your materiality is. So low value is more the concept of actual the value of the asset regardless of the business. So it doesn't matter if it's your own business or your Tesco's, the low value asset consideration is the same. And if it meets those criteria, either low value or short-term leases, you'll just recognize it through the P&L on that straight line basis. So I think examples here of things that wouldn't meet the criteria of low value. So cars, vans, buses. It's coming back to this idea that to an organization, a large organization like Tesco's, an individual car may be immaterial in their accounts and their reporting, but that doesn't mean to say that it's a low value asset. I think sort of IFRS sort of gave sort of guidance around when it first came out and was talking about this, about assets, sort of low value, maybe sort of £5,000 or less. Again, it's not completely specified, but that's you're looking at that kind of thing. So to my example of a printer or something like that, that may be a low value asset. So you wouldn't necessarily have to recognize that on your balance sheet. How are we measuring the lease liabilities? So it's that present value of lease payments outstanding. So that's where we're sort of looking at. So you're sort of looking at the current value, and we're talking about, there is a bit more sort of detail in there. So sort of the fixed payments, variable payments would be included, but only if they're dependent on an index or rate, as it were. So if they were aligned to CPI or sort of inflation, whereas a variable payment that is aligned, that may or may not happen, is less guaranteed. So it's sort of more judgmental. You wouldn't include those variable payments in your lease liability. So you can include variable payments, and you should include variable payments where it is fixed to something, an index or a rate, but not if it is just dependent on an outcome in 5 years' time that no one can kind of judge at this point. So thinking about that, residual sort of value and guarantees, if there are purchase options, these and penalties for terminating the lease, if those are going to come in. So again, these come into a bit more detail in certain leases and may not be applicable in others, but those should be considered in that present value done. The right of use assets, its initial measurement is the lease liability, but you would also expect there can be differences. So you can include initial direct costs of setting up the lease, so that could be then capitalized into the asset. Any sort of lease payments or made before the contract, or lease incentives, that would be added into the assets. And I think importantly, thinking about estimated obligations for costs to dismantle or restore the assets. So thinking about what are you going to have to pay at the end of the lease? Are there effectively the dilapidation costs that are being put in? That now would be considered and brought into the right of use asset. So again, that there are situations where the right of use asset and the lease liability may be different from the start, but the starting point is that the right of use asset will effectively match that lease liability. I mean, there are sort of slight changes and again, more detail into fundamentally looking at, do I have a lease? Is there an asset, an identified asset that is there? And I think some of these sort of terms are quite useful because it could be specified explicitly in a contract or implicitly at the time it's been made available for use by the customer. So there can be leases, in consideration where it's not explicitly in a contract, it's implicitly there. So, but there are aspects where maybe it looks like it's an asset, but is it actually an asset for us that we should be recognizing it under these new sort of section and consideration? So this is where potentially, if the supplier maintains that substantive right to just substitute the asset throughout the period of use, but there are sort of, again, criteria. So it might be that you don't actually you don't have the lease asset that you think you might. So again, it does require a little bit of thought and consideration. Most of the time, it should be quite straightforward, but there are situations that mean that actually the supplier maintains and has that right to substitute. So could move it for a different asset at any period, and so or could benefit themselves from substituting something else. So again, it should be majority of the time is relatively straightforward, but there are parts now that just need to be considered. Is it truly an asset that we should then account for as a lease, or is it a non? So thinking about those sort of pieces, the lease term, when we're thinking about that present value that we should be bringing on, and how long is that for? Reasonably certain that is not going to be taken. Therefore, you should be thinking about bringing on the full length of the lease rather than up to the break clause. And this may be a change on recognition for a number of you, as often in the operating lease notes. A lot of the time, it's thought out to potentially just the break clause, as that's the contractual obligation. Now we're starting to think, going, how likely are you going to move? Are you going to change offices in 3 years' time? Is that really something you're going to do? Or is it just an option? But actually, you're likely now going to be there for the full 10 years of the lease. So thinking about that now, and it's got to be reasonably certain. Judgment again comes into this part, as that's reasonably certain. So you can look at things like past history, can evidence it, if how likely is it going to be that you continue. Again, areas of things like how cost effective is it to break or extend the lease. So moving offices, how much would it cost to go and find a new office, move everybody across? Is that therefore an indicator that you're not going to necessarily make that break clause and take it when it's available? So these are the kind of things to think about, and I guess from an auditor's point of view, when we're sort of coming in and we're talking to you about it, it's that kind of consideration and thought process and I suppose evidence that we're looking for. What have you thought about why you've used a certain term when looking at that liability? So, as I say, on the commencement of a lease, it's now recognising that lease liability at the present value of the lease payments still to be paid, and a corresponding right of asset at cost. So starting point will be that they match, but there are those considerations that we thought about where they could be different. That can skew the balance sheet a little bit, but fundamentally your starting points, they're likely to match. But what obviously this is going to do is potentially really inflate our balance sheet. The net impact might be minimal, again, those differences, but it could really inflate our debtors and liabilities. Discount rate is again something that the standard now gives a lot more guidance on, rather than leaving it to us to consider and come up with the criteria. So should be discounted. It's an interest rate implicit in the lease. So if it's there, or if it's not readily determined, you can choose on a lease by lease basis to apply the incremental borrowing rate or the obtainable borrowing rate. Now we'll sort of what does that mean? So again, in the definitions here, we've got the incremental borrowing rate of interest would have to pay to borrow over a similar term with a similar security of the funds necessary to obtain the asset. So what is it that we would have to pay, to take out a loan, or on a finance plan? What would that be? So that would be that incremental, and then an amount. So again, it's similar. So we'd have to borrow over a similar term, to be included in the measurement of that the lease liability. So there's a slight difference in the incremental versus obtainable. So it's just, what, but I think the guidance, both sort of considering really what might you go to market to get, and that may differ from business to business. So it's not necessarily that you can point to another business that's using a discount rate or a similar business, because they might be in a different situation. So what is it that the lessee can obtain and get? The lease liability, how do we move this? Is you reduce by the lease payment. So one of the big differences now, because of the way this is structured and because you're discounting it down to the present value, you've reduced that at the discount rates that we've just discussed. How does that then get released out? Well, you unwind it by the lease payments, but also you effectively take into account the interest, the inverted commas interest, that is released as we unwind that discounted amount. So from the lease liability, you will reduce the liability by the payments, but actually you'll also add in the unwinding of that discounted amount. So it'll be increased by the underlying interest. The right of use asset is effectively using cost model or revaluation model. So if you're just using the cost model, the right of use assets, once it's there, you're depreciating that out. So over the length of the lease, you'll end up at the same amount, but there are then differences from year 1 to say year 10, because you'll have a standard depreciation if using the cost model. So the asset will reduce by that. The liability is being done by the physical payments and the unwinding. So the year 1, the start of the lease, you might have a matching liability and asset. Year 2, you're likely now to start seeing differences in those leases and assets and the related assets. So that's how you're going to unwind it. There are implications. Obviously, we're now talking about depreciation and interest expense. So that can have sort of wider impacts, and we'll touch on that in a second. So thinking about the presentation disclosures, we've got much more extensive disclosures now. I mean, clearly it's going to be a huge impact, and this will impact a lot of organizations. Revenue might not have such a big impact, but a lot of people have leases and operating leases that are currently off balance sheet that will be coming on. So there is a lot more, presentation. The balance sheet will look very, very different, but the disclosures will also be a little bit more in depth. So again, spending time, how does that look? Preparing stakeholders that again might not be as aware, might not be working in finance, that there are going to be quite significant changes in how things are going to look. So again, relatively prescriptive on that. Things to think about now with regards to leases, some of these practical challenges that we might find as organizations is, accounting systems, how we sort of setting up our accounting systems. Is there currently automated journals that are taking out depreciation? Do we need to set up new codes because we've got depreciation, we've got interest, we've got new assets, we've got right of use assets? So how are our accounting systems set up? Have we got those aligned? Do we need to spend some time creating new codes and new mapping? Obviously, just if you're an organization with a lot of leases, it's going to take time to go through all of those, document it, make sure those considerations are done and thought about, all those potential sort of challenges around length of lease and other pieces. Thinking about which ones are low value, which ones aren't. So practically, a number of organizations have, a huge amount of leases. If you're a chain of restaurants or hospitality or something like that, or, can be that this could be quite a long and lengthy task just to go through. So just think about giving yourself enough time to look at it. It could, there could be covenant changes or other things that again need to be thought about. If you're putting things through interest rather than purely depreciation, there could be impacts on some of those covenants and the way we're thinking. Also, by bringing on, even though it's matching a large amount of assets and liabilities, especially that liability side, again, some of those covenants out there could be impacted on that, on sort of cover and sort of gearing on those pieces. So it's just worth thinking about those pieces. If you've got covenants, also other stakeholders, as we said, there could be some changes, but that internal accounting system, again, it can be quite an onerous piece. Are you set up for these changes? Are there automated sort of journals and things that are happening now that you might want to change? So there are those. I have got, because I think this is a little bit of one that might impact, an illustrative example. So this would be a 4-year lease, £10,000 per year at a discount rate of 6%. So you can see the initial right of use asset and lease liability there matching in the corner, but immediately year one we are changing that right of use asset, the 36,730, that's effectively and liability, that initial value is that £40,000 discounted down at 6%. We're now unwinding that. The right of use asset is being depreciated straight line, and effectively 9,183, give or take a pound. And then that lease liability is changing by the £10,000 payment, but then you're adding back the interest expense. So suddenly your balance sheet becomes unbalanced. Again, these are the kind of things that if you've got a lot of these, there could be an impact on covenants and otherwise over a longer period of time. So we diverge slightly, we end up at the same place in year 4. So that's just a worked example to try and bring it to life a little bit of how it'll look in the P&L. You will see that interest expense and the depreciation expense. So they'll be going to different areas, different lines. So it will look different. And again, one is a slightly more variable unwind, whereas one is straight line. So could be quite a big impact depending on the leases you have and the number of them and the value of them. I'm going to very briefly touch. We've only got 4 minutes to go. There are a lot of other considerations to think about in here. So there are sort of talks on section 1A. I mentioned earlier, and in some of these fair value measurements is changing, and some of the choices are being removed. So thinking about if you do have fair value is something that it impacts you. There are changes in there which will sort of have an impact on that. We've got new disclosures as well. There are, this is only some, there are more than this, but these are sort of high level ones that could impact you. And we'll probably do some insights in this and put them on our website over the next 6 months. But clearly the revenue and the leases are the key areas to think about, I think, when we're talking about the amends, and I've tried to talk through on each of those sections, but key metrics, EBITDA, profit, net debt, all of these things could be impacted. So this could have a huge knock-on effect practically to your organization, depending, dividend payments, all of these things that just we might not be thinking about. Yeah, we're pushing it down. We'll get to FRS102 and the changes at some point, maybe next year. But we've really got to think about, actually, if it does change, there could be some quite fundamental impacts internally, and even more externally to stakeholders such as lenders and otherwise. So quite a lot to think about practically, not just from a reporting point of view. I will sort of finish here. Apologies, we've not got time for questions. If anybody has, do write them in, and we'll get back to them. We are going to run some more detailed, specific ones to really get into this, because it's taken an hour just to give a high level view on both key sections. So we are going to run one specifically on lease accounting. So that's going to be on the 9th of October. And again, one just looking at that revenue accounting, going to be a lot more worked examples. If you are wanting to look at something specifically, do message us, do let us know, and we can try and bring that into that presentation, just because it's going to be such a big fundamental change that people really need to think about it. And I think having an hour on each is going to be more helpful than this. We are also putting on insights onto our website as well. They will be continuing over the 6 months, and as ever, there are a lot more than on there than just these. So do drop into our website as well if there are pieces in there that you might want further information on. We might set up a few more things in there as well going forwards. And with 1 minute to go, just leaves me to say thank you very much for all that have attended. As I say, any questions, please do get in contact. We can help more specifically with you, or look to bring things into future webinars. If there's other areas that you might want discussed in webinars, again, do let us know. But thanks very much, everybody, for joining, and hopefully see you all soon.